Hello everyone and welcome back to Nonprofit Auditor Points, and I'm Irina Ryshkova, your nonprofit auditor. And today our last episode on the fixed asset series. Over the past several episodes we discussed various topics related to fixed assets. Specifically, we identify what fixed assets are. We talked about capitalization policies, proper recording of disposition, acquisition, depreciation, disposals of the fixed assets. We also talked about construction in progress, concept, and place in service dates. We talked about allocation between land and building acquisitions. And in today's episode, we're going to focus on several special situations for nonprofit organizations commonly encountered related to fixed assets. Many of these situations are more unique to nonprofit organization and often involved gifts in kind, donor restrictions, collections, and unusual valuations questions. Let's talk about them. From the audit perspective, these areas often require additional documentation, sometimes judgment, and clear policies. So we're gonna discuss today fixed assets received as in-kind contributions. What are they? How to account for them? Giving away fixed assets owned by nonprofit organizations. Do we ever consider fair value when nonprofits dealing with the fixed assets? What are collections? We're going to talk about net assets release, if there is any long-term assets were donated with donor restrictions. And finally, importance of the organization's policy and procedures surrounding fixed assets. Okay, let's start. Nonprofit very often receive donated assets such as vehicle, furniture, equipment, computers, artwork, and even building and land. And when a nonprofit receive and contributed fixed asset, the organization generally record both contribution revenue and related fixed assets at fair value of the date of contribution. So the entry will be debit fixed assets and credit contribution revenue. And it is important to remember the in-kind gift is recorded at fair market value. That's different from the cost concept that we discussed in the previous videos. At this important because organizations sometimes incorrectly record donated asset at zero or nominal amount or even donor provided original cost. Donor provided cost is critical for a donor, but it's not relevant for the nonprofit. Under GAAP, the focus is generally on fair value at the day when the organization receives the asset. And similar to purchase fixed assets, the organization may also capitalize certain additional costs that are necessary to place asset into service. For example, transportation, installation, setup, and required modification may be part of the capitalized asset. Even though the asset itself was donated, extra costs to put the asset to its intended use was incurred by a nonprofit, and that cost can be added as a fixed asset. Once the donated asset is placed into service, it is generally depreciated in the same manner as a purchased fixed assets. If the assets has a useful life, unless it's a land we do not depreciate. Now, let's move to another important situation. What happens when organization gives away a fixed asset that organization already owns? This is another area where organization sometimes becomes confused. For example, suppose a nonprofit donated a vehicle or computer or equipment or furniture to another nonprofit as a part of their program activity. Under GAAP, when an organization gives away a fixed assets, it's considered contribution and it's measured at fair value. not at cost, not at residual value or net book value. So therefore, at the same time, if nonprofit donates fixed asset to another nonprofit, it needs to remove existing fixed assets from the books by debiting accumulated depreciation and crediting the asset, but records donation at fair market value. If the asset fair value is different from its carrying amount, the organization may also recognize gain or loss on disposal. So the same way as you would dispose the asset. So conceptually, accounting resembles to disposition. The only reason that the contribution when the asset is given away is recorded as expense. Let's look at practical example. Suppose a nonprofit owns a van and original cost of the van was $60,000. Accumulated depreciation at the time when nonprofit decided to give away the van was $50,000. Therefore, net book value was $10,000. Now, suppose the van actual value is only $6,000, even though net book value is $10,000. Because it has a high mileage and some mechanical problems. So if the organization donates the van to another charity, the donation is generally measured using fair value, so the organization may recognize contribution expense based on fair value, which is $6,000, remove asset for $60,000, accumulated depreciation for $50,000, and recognize loss, which is $4,000, is a difference between carrying net book value or carrying amount and fair value, which was $6,000. So $10,000 minus 6, loss will be $4,000. And it is very important conceptually. So organizations generally do not give away the asset at net book value. It always gives away the asset at fair market value. So accounting follows fair value, while the difference between fair value and carrying amount on net book value is reflected as disposal accounting, meaning like a loss. Now, let's talk broadly about the fair value determination, because fair value becomes important both when organization receives fixed assets and when organization gives away a fixed asset. And this is another area where judgment is often required. For common assets such as vehicle, office equipment, standard furniture, organization may use market comparisons or online available data valuations or dealer estimates or other similar pricing information. But more specialized assets such as land and unique building, organization highly recommended to use professional appraisals, engineering report, expert valuation assistant in order to come up with the correct fair market value estimate. And because typically these amounts are very material and substantial, appraisals are very highly required. The organization should also consider condition of the assets, such as age, functionality, if there's any damage, obsolescence, and marketability. For example, two identical pieces of equipment may have very different fair value depending on the condition, remaining useful life, or operational status. And for audit perspective, documentation becomes extremely important in such situations. So auditors typically ask how value was determined, what market information was used, what appraisal were obtained, and whether management assumptions appear reasonable. And the more expensive and material the amount, more reliable support should be available. Let's move into another area that's somewhat unique for nonprofit organizations. This is the concept of collections. Certain nonprofits, such as museums, libraries, universities, historical society, or cultural organization, may maintain some collections of art, historical treasure, manuscripts, rare books, or other items. Under nonprofit accounting rules, collections follow some unique accounting treatment. We're not going to talk about collections in details because it's a very unique topic, but generally, collections involve items that are held for public exhibition, education, or research, protected and preserved, and subject to policy requiring proceeds from sales to be used to acquire additional collection items. Now, there is one of the unusual parts of nonprofit accounting. Organization may have policy and choose regarding capitalization of qualifying collections. So nonprofits can actually choose how to treat collections. So if your nonprofit have collections or items that might be considered collection, your nonprofit should have a policy selection how to classify and treat collections. Some nonprofits capitalize all collection items, meaning they record them as a fixed assets. Some capitalize prospectively, and some elect not to capitalize collections at all. But whatever policy your organization adopt, it should be applied consistently. And if nonprofit decides to change policy, it needs to be considered carefully and apply appropriately. Organizations generally should not collectively capitalize only certain collection items while ignoring others. And if collections are not capitalized, the organization still typically provide disclosures describing the collections, what are preservation policy, and what accounting treatment the organization uses to treat the collections. Now, let's move into another important unique area for nonprofit specific topics. It's net assets release related to long-term lived assets. This area often creates confusion because long-lived assets frequently involved donor restrictions, capital campaign, building project, or restricted contributions. For example, suppose a donor contributes cash and specifically restricted for purchasing equipment or some medical equipment or maybe medical bed or constructing a facility or renovating a building. Initially, the constructions is generally recorded within net assets with donor restrictions. Then, when the organization places the related long-lived asset into service, the donor restrictions is often released and reclassified into net assets without the donor restrictions because restricted cash was already spent for restricted purposes. So the purpose was met. And this connects directly back to our earlier episode on construction in progress and placed in service. The place in service date is important not only for depreciation purposes, but it also may be a point when certain releases from restrictions are actually should take place. So now when one thing organizations sometimes misunderstanding the ideas of implied time restrictions, under GAAP, organization generally cannot simply create automatic policy saying we will release every building gift gradually over the useful life of the building. Instead, organization generally follow donor actual restriction language that applicable to accounting guidance. So careful review of donor agreement and restriction language becomes very important. So in a case, if the donor specifically asks that money should be used to build asset or acquire fixed assets. If such asset has been built or acquired, the donation would be released from restriction. Because fixed assets accounting is not only about depreciation calculation, it's also involved internal control, classification, valuation, donor restrictions, and accurate financial reporting. It becomes quite a difficult and complex topic. Strong organization policies and procedures should be implemented by every nonprofit, regardless of its size, and even regardless of the fact if nonprofit has a fixed asset or not. Because sometimes if the policy of a nonprofit indicates that only assets that are below specific threshold needs to be capitalized, let's just say like $5,000, it means that everything below $5,000 can be expensed. But if not such policy exists, how a nonprofit can justify that there is no fixed assets? So strong organizational policies by a nonprofit should include capitalization threshold. It needs specifically distinguish between repair and improvements, capital improvements. Document if the fair value going to be used, how fair value for each asset that donated away or accepted as a donation should be determined. Nonprofit should have a policy how to maintain accurate inventory records of the fixed assets. When physical observation of fixed assets should be performed, how often, and properly how depreciation should be calculated, what methods should be used, and the policies needs to be applied consistently, and everyone who involved in acquisition or maintaining fixed assets should be aware of that policy. Policy needs to be reviewed and accepted by the board. So before we conclude that series, let's briefly summarize overall fixed assets life cycle as we discussed through all these 8 episodes. So first of all, organization acquire or received fixed assets. Then the organization determine capitalization treatment. After that, organization records and depreciate fixed assets. Then it's review inventory and disposal periodically, at least annually, evaluates construction and progress and place in service timing, allocate land and building costs if as necessary, and eventually dispose or donate asset when it's no longer needed. Hopefully you enjoyed this series on the fixed assets, and hopefully you learned something, and I'm looking forward to see you for your next series on accounting treatment related to nonprofits. Thank you so much. Thank you for being here with me. Have a wonderful day and be safe.